the line chart, close only, is of crude oil. I imported crude oil from the beginning of 2011, and I'm displaying the first about a year and a half here. And I got some support resistance levels that I used Excel to calculate. And as you can see, I'm doing a pretty decent job catching the bottom and catching the tops here. And how did I do that? I want to share that with you. I selected a random number between 77 and 114. This Excel formula here, this is my close data of crude oil starting beginning of January 2011. $77.19 was the lowest price traded in this price series. $114.04 was the highest price traded in this price series. So that's why I'm selecting a random number between 77 and 114, and I'm doing it 3 different times, as you can see. Now, I have this program so that every time I hit my F9 key, the chart stays the same, but my support resistance levels change. These guys over here. And I found it interesting that sometimes I'm picking tops, and sometimes I'm picking intermediate levels, midpoints. Sometimes I'm catching congestion areas. But what's interesting is that the random numbers. And you see, this over here is not just, well, you know what, I'm going to hold off on theorizing until the very end. Let's just present the pictures, and then we'll see what goes on. I'm picking the top and I'm picking the bottom here. I'm picking them. You can see this is classic. Break support, come back and test support, fall back down to the next level of support, support held, go back up to resistance, failure swing, test the second time, fail a second time, break resistance, come back, resistance becomes support, come back and test support. Okay, couldn't go and reach this level? All right, so we fall through support to the next support level. This is classic. But it's also fake. Anyway, what I want to do next is show you maybe a little bit deeper in this. I'm going to show you another spreadsheet. And here's what I've got going on here. Same concept with the horizontal lines. Let me use this chart. It's the same concept with the horizontal lines. I'm selecting a number between 10 and 160. But now, this chart is not of crude oil anymore. This chart that you're looking at is made by my selecting a random number between -10 and 10 and adding it to the preceding number. Selecting, so I got 3 ones in a row, a cluster. Select a random number between -10 and 10 and add it to the preceding number. -7 added to a +2 equals 5. Select a random number. Well, it selected 3. Add it to 5, you get an 8. And I'm charting that. And there's a number of interesting things about this. The first is you can see that when you chart a random number series, it appears to look an awful lot like a price chart. It's got intermediate term swings. It's got longer term swings. It has major trends. It has corrections. It has failure swings. It has support resistance levels. These support resistance levels are also random numbers. So, as you can see, you can simulate price activity simply with random numbers, and you can find support resistance levels on real price data, or you can go full-blown like this, random number series being charted as if it were a price series, random number series being charted as if it's a support resistance level. Let's go a little bit deeper into this. What I did was I took this random number series, added a date to it. I arbitrarily chose January 1st, 2010. And I'm exporting this column right here, which is made up of adding a randomly selected number to a previously selected random number. And I'm going to export that and import it into Fibonacci Trader. And I'm going to compress it into a weekly format. Remember, if I'm speaking too fast or you're not following me, I'm exporting it as daily data, January 1st, January 2nd, January 3rd, inside Fibonacci Trader. compress it into a weekly format. And there's several things that I want to show you here. One, it looks like a really nice regular price chart. It looks like a wide range chart. Furthermore, I applied a momentum indicator and I asked Fibonacci software to show me the divergences. And it does so by drawing me these arrows right here. That looks really good. That looks really good. That looks really good. 3 arrows and they all look pretty good. This doesn't mean that momentum divergence is an accident. It doesn't mean that you should or shouldn't use it. That's not the point of my presentation here. My point so far is just that, well, random price series can look like a price chart and they can trigger trading signals just like a regular price chart. That's all we know so far. One more thing I want to show you is got candles here, and you're probably familiar, at least the experienced traders are, you're familiar with the chart pattern called key reversal. Well, key reversal would be, I'm making a market downswing, price makes the lowest low in that downswing, and yet the close is above the prior close. I have that here. I have that here. We have an upswing, I have a higher close, I have a lower close. I'm sorry, we have a higher high, and we have a close lower than the prior close. That's a key reversal. I have it over here. I have a nice, long, strong downswing. I have the lowest low of that series, and I have a close higher than the prior close. I almost have it here, not quite. The closes look equal. And I have it over here. I have the lowest close in this downswing, and I have a close higher than the prior close. That's a key reversal. You can look at, you can key that phrase, key reversal, into a search engine. You can see it's an accepted chart term. And I'm doing this with random data. And this doesn't mean that momentum divergence or these chart patterns, you should or shouldn't use them. It doesn't mean that they're accidents. It doesn't mean that they're good, not good. I'm just showing that they can be triggered by random price events. Now, let's go a little bit more on the esoteric side. So far, momentum indicator, momentum divergence chart pattern, support resistance levels, that's all pretty straightforward, commonly used. Let's go a little esoteric. So what I'm going to do now is I'm going to take that randomly produced number series and I'm going to import it into a software that I personally use and I recommend. It's called Timing Solution. And we're going to go a little esoteric here. The first thing I want to do is I'm going to do something a financial astrologer would do. Now, this is available on YouTube, which means the general public can see it. So I know most of you viewing this probably are not financial astrologers, but this is something you'll have to take my word for it that people would commonly do. I'm going to select the sun. I'm going to select the planet Venus, the planet of money. And I'm going to select the planetary aspects, which are very commonly used. And I'm going to calculate them. I'm going to add, culmination, find the exact date when these aspects come due, add it, calculate it, and let's take a look. Okay, now this is interesting because I want to go through this again so you really appreciate. I know some people don't appreciate this and some people find it eye-opening, but hold off on reaching any conclusions. What I did was I created a random number series here, random number series. I arbitrarily added a date to it, starting in January 2010. I imported into software, and then I apply planetary aspects to it. And over here, not so much, but I'm catching a pivot, almost exactly. Nothing here. Minor something here, but I'm catching a major pivot again. I'm 1 day off, 1 bar off from catching a mild correction in the strong uptrend. And I'm catching a pivot again. Catching a pivot. Nothing here. Nothing here. It depends on your viewpoint. We have an upswing. We have a consolidation pattern, and the breakout occurs right there. Upswing, consolidation, breakout to new highs happened right there. Pivot, not really. That's 1 or 2 days off from a major low. That's 1 day off from a major correction, the strong upswing. Okay, I don't want to beat this to death, but the point is I'm using a random number series, arbitrarily chosen dates, and if you didn't know that, if I made up this is some market in a country that you don't trade in, and I've got this planetary aspect that I think works really hot on it, and you're familiar with financial astrology, and I tell you Sun, Venus, these are the aspects, you go, you might be tempted to say, actually, you wouldn't be tempted. You'd be saying, hey, this is really good. This is really, look at all the pivots you're catching. Let's get rid of that. Let's look at something else. Let's look at cycles. This, by the way, this software can do some amazing things in finding cycles. So I just showed you some financial astrology. That may not be your forte, but if you're into market geometry techniques with drawing tools, pitchforks, Andrew's work, Charles Babson, action and reaction lines, anything to do with Fibonacci, this software can do amazing stuff. But primarily, I think it excels with cycles. So we're going to do some cycle work now. Again, random number series. I'm just going to start with the slow and go up and just hold it. They'll just leave it there. See what happens. Now, so these are basically arbitrarily drawn vertical lines. And I'm catching the top here. Nothing here. I'm catching a top right there. See it? Look at that dark line right there. I'm catching a top. I'm catching a bottom. Nothing here. Breakout, consolidation, breakout. I'm catching a top right here. 1 day off from this trend resuming. 1 day off. Minor pivot. Major pivot right there. Major pivot. Major pivot. No, sorry. Minor pivot. My mistake. That's interesting. That's a pivot. Look at that. Look at that. Now, this is a random number series. Let's do it again. Let's this time go from this low. Instead of going from low to high, let's go from low to low. Okay. Going from low to low. Consolidation, breakout, pivot, couple of days off, couple of days off, 1 day off, 1 day off. That's it. That's awesome right there. That's awesome. Look at that. Look at that. Now, also pivot right here. So the bottom line is, I'm not saying this is good. I'm not saying this is bad. But what I'm showing you is that I am so tempted to give you my underlying, market theory, market philosophy on this, that I'm biting my tongue. So I'm just going to stop that. I just want you to see this and be able to draw your own conclusions. There's something I want to add to this, which I personally feel is important. And I won't be going into the philosophy and theory stuff here. I'll just be showing you something else and letting you draw a conclusion on your own. Here's some chart patterns. These are real price data right here. Now, market's falling, forms a pivot at point A. Market corrects. Market goes back down, performs a pivot at B, and starts to rise. We call that a failure swing, and it's a reversal pattern. We expect the upswing in price to continue. Here's a double bottom. Market downswing, market corrects, market forms a pivot at B, starts to go up. We call that a double bottom. We expect prices to keep going up. Bear trap or false breakout. Market forms a pivot at A, price goes below A, forms a pivot at B, starts going up. We call it a bear trap or a false breakout. We expect the upswing to continue. My point is, if this point at B, this pivot B, if it can go up above A, equal to A, or below A, A is pretty much irrelevant. And the fact that we as chartists say there's a cause and effect or a supply and demand relationship here, well, that may not be right. That may be some projection or rationalization you're making in interpreting market data, because quite frankly, we're wired to do that. When we see something abstract or something random, we want to be able to explain it. And certainly if you're going to put money on it or you're trying to develop a trading system, you want to find some cause and effect or logical relationships between the events you're looking at on your chart. Let me show you another one. This is concerning news reports. This is very common. Let's say you just had a bullish news report today, or a bullish rumor, or a bullish anything. If price goes up, that's why it's called bullish. If price stays the same, doesn't change much, that means the insiders, well, they're privy to information. I'm sure you've heard this many times. Well, the insiders get information faster than you. The professionals are able to know this information before the retail public. And that's why by the time it makes it to the news or to this website, the insiders already knew it. The market's already discounted that information. Now, what if the bullish news comes out and price does the opposite? It goes down. Bullish news, bearish result. Well, how many times have you heard this one? Everyone knows you buy the rumor and you sell the fact. So once again, bullish news, price can go up, rationally explained. Price can stay the same, you've got a rational explanation. Price goes down, you've got a rational explanation. But it's not rational. It's a rationalization. Because the price can do anything after your bullish news event, then your bullish news event was irrelevant. So in point of fact, there's not a whole lot more I want to show you. I'm going to go through why I think price is more like a random price series than you might think. But I want to show you one other thing in the spreadsheet. Let's do it here. Let's do it with our crude oil chart. Again, I realize this rubs some people the wrong way, and I don't know why. I started doing this presentation between the years 2004 and 2006. Some people really like it. Majority of people say that's interesting. I don't know what I can do with it. And a small percentage of people really get a little ticked off. I get nasty emails. They tell me I don't know what I'm doing. They say I'm out to get somebody, but you see what you see. Wait, why should this information be hidden? What's the value in hiding this? At any rate, let's go to this chart right here. Notice how these vertical lines are picking bottoms. Not here, but here. Not here. He's picking a pivot here, picking a pivot here. Not much here. This is randomly chosen. These vertical lines are randomly chosen. Let's do that again. Okay, so now the horizontal lines change. Here's what I do. I have this number here, 46, and I've got time here. What this is, I'm selecting a random number between 20 and 50, okay? And I'm going to use that in the following manner. Right now it's got a 46. So let me show you what I'm doing. I'm going to change this to a 46. Click OK. And what from the very first price plot, the very first closing price of crude oil that is displayed here, we're displaying crude oil, it's going to count out 46 and draw a vertical line, count out 46, draw a vertical line, count out 46, draw a vertical line. Okay, we went from down to sideways. We kind of caught the top here because the market went up, but it didn't really keep going up. It went into a consolidation pattern. So we caught the top of a swing here. We caught the change in price from up to sideways. We're 1 or 2 days off from catching the exact bottom here. Nothing here. And we're 3 days, three price events, 3 closes away from catching the bottom here. Let's just do it one more time. I don't want to beat this to death. And now I got a 28 here. Let's change that to a 28. 28. So start from the beginning, count out 28. I get a pivot right here. I get a pivot right here. Nothing much here. I get a midpoint here. I kept the exact bottom. That is the lowest low on this chart, and this vertical line caught it. Market goes up, market corrects a little. This vertical line caught the end of the correction. The upswing resumes in crude oil. Same thing here. Market goes up, goes into maybe an 8 or 9 days consolidation pattern. Breakout, final consolidation pattern, downswing. You know, am I spinning it? Maybe just a little, but you know what? What do you see? Do you see absolutely nothing? Are you really going to try to tell me that there's absolutely nothing here? That this is all in my head? I'm making this up? I'm just babbling nonsense? Are you really going to try to tell me that this horizontal line is not where this upswing congested? It broke through, it tested this make-believe resistance level and fell to the next level of support. Am I really making that up? Do you really want to test your own belief system that hard? Oh my God, I just squared price and time. So listen, you got some work to do. You can take what you're seeing here and saying it's all nonsense. This has nothing to do with your trading methods. It has nothing to do with trading. Or you could be a little bit more open-minded and at the very least understand several things that are right in front of your face. These are real prices here. This is crude oil closing prices. This is not a random price series here, but these vertical lines and horizontal lines are. I can spin this in so many different ways. How much are your trading techniques, how much better are they in terms of finding support resistance levels and in terms of finding potential turning points than what I'm doing with purely random phenomena? Okay, so at the very least, you can't ignore, this here, by the way, is not crude oil. This is a random price series. You can't ignore that a random price series looks like a price series. You can't pretend it doesn't because you're looking at it right now. You can't pretend that arbitrarily drawn vertical lines don't catch pivots because you're looking at it right now. You are actually seeing it, and if you deny it, you are lying to yourself. You can't deny that chart patterns that you believe are commonly known, representative of supply and demand, can happen as a result of purely random events. All I'm doing here is charting a random price series created with an Excel spreadsheet. And I've got beautiful momentum divergence arrows here. I've got key reversal patterns. I've got a false breakout here. So in this particular video, you can stop now. I'm pretty much done. Now I need to do one more thing, and this is up to you if you want to listen to it, is I need to give you some more information if this presentation has an appeal of, well, okay, you showed me that you can do that with a random price series, but can you do it with a real price series? Actually, I did do it with a real, it's right here. This is a real price series, crude oil. But how much of this, why are you saying that price series like crude oil or a stock index or a Forex currency pair or crude oil, why are they like a random price series? So that's what I want to do next. I'm not saying that price series is random. I'm saying that a nonlinear data stream, which is what a price series is, behaves as if it's random. A nonlinear data stream will at times falsely mimic anything you believe to explain market behavior or use for a trade setup. Now, I contend the nature of price movement is a nonlinear data stream. Now I'm going to explain that a couple of slides down, is irrational by its nature, and any attempt to understand it will fail. Here's the key word: consistently explain it, because sometimes you will get temporary correlations, obviously. And traditional statistics, technical indicators, economic models is such a rational attempt. The reason I call a price stream a nonlinear data stream is, here's exactly why. A price series is made up of several variables. Traders who have different motives, and I'll explain that, and different information. Variables are not active simultaneously, and the relationship between the variables is not clearly defined. This is very abstract. It needs a little explanation. And I think the best I can do for you right now is to tell you that we make an assumption when we analyze price that it's the output of one entity, whereas in point of fact it's not. There's no such thing as a market. There's different people spread throughout, these days, the world, not just one country, the world, trading crude oil, trading the US stock market, trading our bond market, etc. And they have different motives. For example, you have very short-term day traders like scalpers and people who trade very short swings. You have people who trade the larger swings in the day trade, people who trade the trend of the day. You have swing traders, position traders. But that's minor. I would say 20 years ago, maybe that accounted for some of the volatility. These days, there are two things that account for price being a nonlinear data stream. Two things more than anything else. The first is portfolio reallocation. In all of our major markets, they're dominated now by institutional trading, whether it's commodity pools, hedge funds, money managers. These people on a daily basis reallocate their position sizes in different markets based on what they feel the profit opportunities are. So for example, real life example, I'm working with the head trader of a New York City hedge fund in 2004. He gets a phone call. They got a great opportunity in the Euro USD, but they don't have the capital to initiate the position. He's got over 40,000 contracts on in T-notes. He says liquidate 7,000 right now at the market and put it into the Euro USD trade. Now, when he said sell 7,000 T-note contracts, he was not expressing an opinion on market direction. And that will move the market by a couple of ticks. So this goes on all the time. It goes out, it goes on during the trading day. There's millions and millions of dollars reallocated every single day, not because someone thinks the market is going to go up or going to go down, but because some customer wants to withdraw money, or a bunch of customers have added money and they're required to put it into the market, or they have different opportunities, or because they're simply going for this size trade and they want to lift the trade because they want to make their quarterly report look good. And you're talking about hundreds of millions of dollars every single day being reallocated, and it has nothing to do with anybody expressing an opinion on market direction. Then you have the activity of hedgers. There's only one reason. There's the Forex market. There's only one reason. There's the futures market, and that's for hedging. There is no second reason. And then you have this, which I believe is very important, and people have very little understanding of. When I put a trade on, I have a reason for putting that trade on. I can explain it to myself or to you. When I lift the trade, it could be because the market went flat, and I don't want to risk my capital in a sideways market, so I lift the trade. It could be because a trailing stop got hit at a profit. It because my stop loss got hit shortly after I entered the trade. Whatever the reason is for my closing a trade, I was not expressing an opinion on the market. And when you put a trade on, or when you close a trade, there is nothing in your charting software that differentiates between the two trades. They are all treated as the same thing. 40% of all the volume in all these markets every single day is people closing trades. And when you close a trade, most of the time, if not all of the time, you are not expressing an opinion on the direction of the market. And that's why I call price a nonlinear data stream. This was important to do because if you can understand that price is a nonlinear data stream, then you understand, where's that little slide? That price will behave as if it's a random number series. If you can understand that, then you've just taken a major step in understanding this, and understanding this, and in understanding this, and hopefully, and not being a sucker to some vendor's promotional scheme, or faking yourself out with testing that may or may not show a lot. You know, if you catch something like this with what you're doing, basically, I'm not saying all vendors are crooks. No way. They're just as naive as me or you. So basically, if I were testing real life methodologies here, and I go, damn, I caught a pivot here, I caught a breakout right here, I caught the bottom of the chart here, maybe this technique I'm testing is